Hello and welcome. My name is Bianca Beck. I am the Middle East and Mauritius Marketing Manager for Sovereign PPG, part of the Sovereign Group. I'm very pleased to introduce you to today's webinar topic, which is to help UAE businesses prepare for the September deadline when we refer to UAE Corporate Tax and E-Invoicing. Just a couple of things for you guys to know. We are recording the session, so a recording of the presentation and the presentation will be shared with you in an email after we conclude today's session. Another thing is we really do encourage questions. So the Q&A or chat function are open for you to ask questions that the team will be able to address at the end. And yeah, we hope that you gather some really important information about being prepared for the deadline with some time now that it's only August to prepare you for next month. I'm very pleased to introduce you to the team that you'll be hearing from today. We've got Mohammed Amer, who is our client accounting manager here in the UAE. Joining him is Samir Ansari, who's our senior client accountant. And then last but not least, Matthew Boyd, who is business development manager here in the UAE. So I'm going to hand over to Matt to start with, who's going to take you through what to expect today, as well as where the UAE corporate tax stands as of 2026. Matt, over to you.
Perfect. Thanks, Bianca. Hi, everybody. Nice to meet you all. Thank you for taking the time out of your day to attend this session. So I'll just go for a quick run through of how this is going to play out for today's session. So it's going to be a five-part introduction and overview of corporate tax, what the environment looks like, and obviously how we at Sovereign can support you, your clients, or indeed your business in the region. Just next slide. Perfect. So UAE corporate tax. So rather than go into the super weeds of everything, I'll leave that to Samir and Amir to go through. Essentially, corporate tax is a fairly new piece of legislation in the Middle East. So we now have it in Dubai since 2023, with many businesses now reporting what may be their second corporate tax year. It came in the 1st of June in 2023. We have a regime of 9%. Of corporate tax, or indeed zero should you qualify, and obviously Amir and Samir will go through how your business can qualify for that 0% threshold. And then obviously this is applicable to everybody. So if you have a free zone, a mainland, or indeed a RAC or an offshore UAE entity, you have to register for corporate tax. There are fines and penalties for not doing so, and you must submit 9 months after your year end. So many businesses that are running January through December tax years will then have to file in September. And we obviously have a filing deadline coming up at the end of next month. So it's quite useful maybe for you guys if you need any assistance with any filings or accounting or bookkeeping. Amir and his team are more than capable of assisting you with that. Slide. Perfect. So that's a very, very quick overview, and I'll obviously hand over now to Amir, who'll go through the corporate tax compliance and qualifying free and personal rules and regs and how your business can qualify for those rules. Over to you, Amir.
Thank you, Matt. All right. Good afternoon, everyone, and thanks again for joining us today. We have quite a bit to cover today, particularly because the corporate tax landscape in the UAE has moved quite quickly over the past couple of years, and we are now at the stage where the focus is shifting more towards compliance, reviewing, and making sure that the positions being taken by the businesses are properly supported. So today we are going to focus on mainly two areas. First, we'll look at the corporate tax compliance and qualifying free zone persons rule, including some of the recent developments that happens particularly relevant to the free zone businesses. And then we'll move on to small business relief, including the recent extension of the relief to the tax periods ending up to 31st of December 2029. And we'll also look at penalties associated with non-compliance of corporate tax regime. I'll try to keep this practical rather than going through the legislation line by line. So wherever possible, I'll focus on what changes actually mean for the businesses, and more importantly, what we should be looking out for compliance from the compliance perspective. So let's get this started. All right. So before we get into the detailed rules, I thought it would be useful to take a step back and look at where we are today with this regime. So when the corporate tax was introduced, there was obviously a lot of focus on registration, understanding the legislation, and getting the businesses through their first filing cycle. But at this stage, for many businesses, their first filing cycle is already completed and focuses on increasingly moving towards compliance review and audit readiness. So it's not just about asking, have we registered, have we filed? It's about asking whether the positions we are taking in the returns that we are filing can actually be supported if the FTA comes back and asks questions. So yeah, moving on to the next slide. All right. So as you guys might be aware already until now that every UAE company has to register for corporate tax, whether if it's a mainland company, free zone, or any offshore entity. So if you have a valid license in the UAE and you are carrying out business activity, you will have to register into corporate tax as a part of compliance with this corporate tax regime, regardless of your revenue and your profits. There are obviously certain exempt persons. For example, if there are entities which are government owned, government related entities, or if the business is engaged in any of the non-extractive natural resources business, then those companies can be considered as exempt from the registration requirement. So registration is a normal process that can be done through our tax platform. And every company, once registered, they can get a tax registration number upon successful registration. New entities are required to register within 3 months of their incorporation, and failure to register within 3 months results in the late registration penalty of 10,000 dirhams. However, there is a relief available for the waiver of this late CT registration penalty, which we see in our next slide. Okay, so usually what happens is once the company is registered for corporate tax, it is required to file annual corporate tax returns within 9 months following the end of the tax year. So for example, for a company whose financial year is January to December, the standard timeline to file the corporate tax return would be September, right? So let's say if the financial year was Jan to December 2025, then the filing deadline for the standard filing deadline was would be 30th September 2026. But if the company is able to file its first corporate tax return before 31st July 2026, then this penalty will be waived off. So there is no separate application required for this waiver application. There is no reconsideration that has to be filed. So simply, if the company after the registration can file its first CT return within 7 months, then this penalty can be waived off. So this is the initiative that has been taken by the FTA, which is obviously good for a lot of companies who fail to register within 3 months of their incorporation. But this is an opportunity for them to get the waiver of the penalty by submitting their corporate tax returns within 7 months after their first financial year. Moving on to the next slide. So yeah, so this is a very important concept that we have covered here, which is the qualifying free zone person. So a lot of the companies, there is a misconception also that if a company is based in a free zone, it can simply qualify for 0% corporate tax. This is not the case. A qualifying free zone person is basically a free zone person that meets the number of conditions under the corporate tax law. And the important point here is the free zone status itself, as I mentioned earlier, doesn't give you the 0% rate. And I think this is probably one of the biggest areas of misunderstanding that we have seen. So if the company qualifies as a qualifying free zone person, so essentially it can have a two-tier income. So for example, it can have the income that qualifies for 0% corporate tax, and it can have the income that qualifies for standard 9% corporate tax. So it is very important to assess and differentiate between the both types of the income so that the proper basis of becoming a qualifying free zone person can be established. There is a complete assessment process and in that assessment, basically, it has to be identified that whether the company can claim 0% tax benefit or not, and it all depends upon whether the company meets all the qualifying conditions specified in the law. We'll discuss all those qualifying conditions in our next slides. Okay, so first of all, these are all the key conditions that has to be satisfied first to towards 0% corporate tax regime. So a very first condition that has to be satisfied is the adequate substance. So for example, if a company who has core income generating activities, who is performing core income generating activities within the UAE, they have proper adequate assets, full-time employees, and adequate expenses to support the revenue that has been earned from the relevant activity, then we can consider that the adequate substance is met. This is the first requirement that has to be met. Then we'll also have to see whether the company is earning a qualifying income or not. Now, there are certain activities which are declared as qualifying activities, and there are certain activities which are declared as non-qualifying activities as per CT law. So we'll have to assess as per those activities whether the particular activities of the company fall within the list of those activities or not. So if the if the activities of the company is qualifying, then which means that the second condition is met. The third condition is no election out, which means that usually within the corporate tax return, a company can elect to be subject to 9% corporate tax, right? So it is the election by choice. So if, for example, if the company have not opted for the 9% corporate tax, then which means that the company will have the option to go for the 0% tax rate, provided that it meets the 1 or 2 requirement. Now, on to the fourth requirement, which is the transfer pricing. So every company which is a qualifying free zone company, it has to meet all the requirements related to transfer pricing. My colleague will walk you through all the transfer pricing regulations and all the requirements in the later slides. But just to give you a brief overview, that if a company have the transactions with the related and connected parties, as per law, those transactions should happen on an arm's length basis, as if those transactions are happening with independent parties rather than any related or connected parties. So it is very important to ensure that these transfer pricing regulations and any other requirement related to documentation of these transfer pricing rules has to be met. Now, moving on to fifth and last requirement related to the qualifying free zone person is the audited financials. So every company which is qualifying for the 0% corporate tax rate, they have to maintain and submit audited financial statements as a part of their corporate tax returns. So if these all 5 conditions are met, then we can move on to the next step and then see whether the company can further qualify and become eligible to apply for the 0% corporate tax rate. Now, there is a slight window which is available under the de minimis rule. So as I mentioned earlier, that a company can have a qualifying income and at the same time it can have a non-qualifying income also. So the qualifying income that is subject to usually 9%, 0% corporate tax, and non-qualifying income is subject to 9% corporate tax. But what de minimis threshold is, where de minimis threshold works is if the revenue of the company is lower of 5% of the total revenue or 5 million dirhams, then the company can also, then the non-qualifying revenue of the company will also be subject to 0%. So even though if that revenue is non-qualifying, but if that falls within the de minimis threshold, that will still be considered as a qualifying revenue. And one last thing from this slide is, for example, if a company fails to meet the qualifying test within its current tax year, it will automatically disqualify from this regime, from the 0% regime for the next 4 years, which means that the company will have to assess again after 4 years of their eligibility to apply for the 0% corporate tax rate, provided that they meet all these conditions. Moving on to the next slide. Yeah. So with reference to the criteria number 2 that has been discussed in the previous slide regarding the qualifying and qualifying activities and non-qualifying activities. So here is the list of all the qualifying activities which has been outlined in the corporate tax law. That includes mainly manufacturing and processing of goods and material, trading of qualifying commodities, holding of shares, ownership and management operations of ships, reinsurance services, fund and wealth management, headquarters services, financing and leasing of aircraft, distribution of goods and material from the designated zone. So these are all the qualifying activities. So if the company's activity falls within any of these activities, which means that the qualifying activity criteria is met, and then the activities would be qualifying at 0%. And then if rest all the conditions are satisfied, then the company will be eligible to get 0% tax benefit. On the other side, there are some excluded activities as well. So if a company is carrying out any of these excluded activities, straight away it will be subject to 9% corporate tax. Now, the last activity from the qualifying list, which is distribution of goods and material from the designated zone. So designated zone concept is more or less the same as we have seen in the VAT compliance purposes. So all the designated zones that has been listed, that mainly works for the corporate tax as well. And it is very important for the companies to ensure that they assess their qualifying free zone status every year. So it's not just a one-off activity which can be done only once when the company is filing its first corporate tax return. So every year, let's say if a company qualifies for 0% corporate tax last year, it has to again assess based on its activities as per the current year, and the activities, substance requirements, audited accounts, transfer pricing. So it has to ensure that all those conditions are met for the next year as well to be eligible to claim 0% tax benefit. So it's an yearly exercise, I would say. And it is always recommended to carry out that exercise every year so that the supporting evidences to submit to FTA at the time of any tax audit can be submitted with reasonable accuracy. Okay, so moving on to the next slide. So small business relief. So first of all, I would just like to give an overview of what this relief is and then how it works, and then I'll discuss the extension. So any company which has a revenue of less than 3 million dirham in a tax year, it is eligible to claim small business relief. By claiming small business relief does not mean that the company would not have to apply for the registration. So it's just that the company will apply for the registration, get themselves registered into corporate tax. Once the company is registered, then at the time of filing the CT return, the company can either opt for small business relief or it can opt to file full CT return. Now, if the revenue of the company is below 3 million dirham, that is obviously to support these small businesses, which has revenue of less than 83 million dirhams, so that they can avail this benefit and avoid paying any tax. So by claiming small business relief, if your revenue is less than 3 million dirhams, you can claim it, and you will not have to worry about paying any taxes regardless of the level of your profits. So earlier, this relief was valid up until the tax year ending December 2026 only. But recently, FTA has announced the extension to this SPR relief by 31st December 2029. However, there are certain companies, there are certain types of the businesses which cannot elect for the small business relief, which is, for example, if a company is a qualifying free zone person, which means that the company is already a qualifying free zone person, it can avail 0% tax benefit. So there is no point of claiming small business relief for that. So that company is not eligible. Members of an M&E group can also claim, cannot claim small business relief if their revenue is above 3.15 billion. And also if in the previous tax year, the company have not claimed small business relief because the revenue was more than 3 million dirham, it cannot claim small business relief in its subsequent years as well. So it basically disqualifies the companies to claim small business relief in the future years once the revenue exceeds 3 million dirham in any of its tax years before this relief is applicable up until December 2029. Okay, so moving on to the next slide. So just a brief overview of what has been discussed in all the slides earlier. So for the businesses, basically the action points should be to confirm that the registration is done on time. And then make sure that if the company can qualify for 0% tax regime, the company should assess that and then provide reasonable supporting for that. If the company have got penalty for the late registration, then it has to monitor 7 months deadline and file first corporate tax return accordingly. As I mentioned, qualifying free zone person test is something that has to be done on an annual basis, so that should be done. And then elect for small business relief wherever applicable if the revenue of the company is below 3 million. There is one disadvantage of claiming small business relief is particularly relevant for those companies who have losses in their current financial years or their previous financial year, is that by claiming small business relief, the companies are not eligible to carry forward losses into the future years. But in case if the company opt out from the small business relief, which means that any losses in the current tax year can be carried forward to indefinite future tax periods and can be offset against the future tax liabilities. So this is the only disadvantage. But other than that, for the companies who have profits, small business relief can really help them avoid paying 9% tax. Okay, so moving on to the next slide. So we have listed down certain important penalties that every business needs to be aware of. So first penalty is for the late registration that we have talked about is 10,000 dirham. And then the second one is related to the maintaining the record. So as per corporate tax law, there is a requirement to keep the records for the 7 years at least after the end of the tax year for which the records are relevant. So the penalties is 10,000 for each violation and 20,000 in case of repeated violation in the next within 24 months from the date of the last violation. In case if a company is required to apply for CTT registration, then it has not applied on time. Usually the requirement for the deregistration is every company have to apply for the deregistration within 3 months from the date of cessation of business activity or the liquidation of the company, whichever is earlier. And the penalties applies based on how much late the company have applied for the deregistration, for example. And the penalties start from 1,000 per month, and it goes up to a maximum cap of 10,000 dirhams. The next one is the fourth one is failure of the registrant to inform the authority in case of any change required to the information pertaining to the tax record. So for example, usually as a part of corporate tax registration, companies usually submit all the legal documents of the company. That includes license of the company, licenses of the owner company, passports and MSIDs of the owners and managers. So all these documents are subject to expiry after a certain period of time. As per FTA law, all these documents needs to be updated at the FTA portal within 20 business days of their expiry. This is to maintain FTA portal in a good standing. So failure to update those documents within 20 business days results in a penalty of 1,000 for each violation and 5,000 in case of repeated violation within the next 24 months. So it is very important for the businesses to monitor their all legal documents and then make sure that all those documents are updated by submitting an application at the portal on time within 20 business days. Um, Now, the next one, the fifth one is failure of the registrant to submit tax return within the specified time frame. So the penalties for late filing of the corporate tax return that applies 500 for each month for the first 12 months and then 1,000 for each month from the 13th month onward. And then in case if the company failed to settle its corporate tax liability on time, then the monthly penalty is 14% per annum. That will apply each month based on percentage. And then if a company have submitted by mistake an incorrect tax return and they wants to correct it through a voluntary disclosure, they can obviously do it, but it carries a penalty of 500. But in case if the company can amend or edit the tax return before the deadline, so let's say if the filing deadline for the last financial year is 30th September 2026, so if the company have filed its corporate tax return, and if they want to make any changes, they can obviously do that without any penalty. But after 30th of September, any amendment will go through a voluntary disclosure, and that will carry a penalty of 500 dirhams. All right, so that's it from my side. With this, I'll hand over to my colleague Samir, who will walk you through e-invoicing and transfer pricing regulations. Over to you, Samir.
Thank you, Amir, for such a detailed explanation. Okay, so first of all, we'll start off with transfer pricing. So transfer pricing is a very important document in terms of if you're, a qualifying free zone person or even if you're not. So we'll just first go over with the overview of what transfer pricing framework looks like under UAE corporate tax law. So Article 34 and 36 requires related party transactions and connected person transactions to meet arm's length standard, meaning that any transaction with the related party or connected persons must be done on arm's length basis. Then there is a master file, excuse me, and a local file that is required to be maintained, but there are certain thresholds over it, which we will discuss in the later slides. And then again, this transfer pricing is based on the guidelines from the OECD transfer pricing framework. So again, it is part of the UAE corporate tax law. On to the next slide. We have the related parties and connected person divided into two different categories. So first we'll start off with the related party. So a related party is a party that can be a shareholder or that can be a group of entity which in terms have related party significant influence over each other. And if there is a related party and there are transactions involved, then a proper benchmarking study and a transfer pricing study must be in place in order to comply with UAE corporate tax regulations. So it's applied regardless of the threshold or regardless if you are a qualifying free zone person or not. Every company that is filing for corporate tax return must have a transfer pricing study in place. However, the UAE corporate tax law specifically requires disclosures if transactions with related parties exceed the threshold for 40 million dirhams in total. If the threshold is not increased, you are not required to disclose while filing the corporate tax return, but still the requirement to have a transfer pricing study done remains intact. So the methods that are acceptable under the UAE corporate tax law includes COP, cost plus method, TNMM, and profit split. So whenever you are doing a benchmarking study or transfer pricing study, whichever method suits you best is acceptable under UAE corporate tax law. But regardless of the fact that you are a qualifying free zone person or not, a transfer pricing study must be done. And once the FTA comes back with an audit, it is one of the documents that they require from you. Now, the second thing is connected person, which is explained under Article 36 of the UAE Corporate Tax Law. Under this law, every person that is a connected person to a company, that includes directors, owners, senior officials, or relatives of senior officials of the company, are considered as connected persons. And if the aggregate value of the benefits or the payments that they are receiving from a company exceeds 500,000 dirhams annually, then disclosures are required. And even though not a detailed benchmarking study is required, but still a market value test is required to ensure that they are not getting, payments which are not at arm's length basis. The reason is that these transactions with connected persons and related parties are considered as an allowable expenditure while filing the corporate tax returns. So if they are not at arm's length basis, so there is a way for companies to overstate their expenses, which will in turn obviously reduce their taxable income or taxable profits. So in order for companies to not overstate their expenses and reduce their taxable profits, this transfer pricing articles are in place, so that you must need to comply with them in order for you to be compliant with the corporate transfer pricing principles under UAE corporate tax law. On to the next slide. Yeah. So master file and local file is one which is required for companies if they cross certain thresholds. If a company has an annual turnover of more than 200 million dirhams, then obviously they are required to prepare a master file and a local file separately. And if their global consolidated revenue is more than 3.15 billion dirhams. So again, the master file and the local file must be prepared under UAE transfer pricing regulations. And when the FTA comes back with an audit, you have the FTA gives you 30-day standard response time to provide with all the workings that you have, the master file and the local file. Failure to do so will result in penalties. And if you are a qualifying free zone person, the FTA can revoke your qualifying free zone person status as well. On to the next slide, please. So, what are the penalties for non-compliance for transfer pricing? Well, the first and foremost is that if you are a qualifying free zone person, then your status can be revoked by the FTA. So if you don't have a transfer pricing study in place and FTA comes back with an audit and you are unable to provide them with sufficient documentation, then they can revoke your qualifying free zone person status, meaning that you will have to pay taxes on the profits that you've earned. However, if you apply for a voluntary disclosure of the TP adjustment that due to some changes in the markets or change changes in the transfer pricing study that you have done, there were some adjustments, there will be a 1% standard penalty. Then if the disclosures are made, and so the first penalty is if it is made before the FTA officers pointing it out. But if the FTA officers during an audit find out that you are non-compliant, then there is a 15% fixed penalty on the amount that has been increased, plus a 1% per month penalty. If you are if the FTA officer deem that you are in a failure to keep the transfer pricing records, then there is a straightforward penalty of 10,000 dirhams per instance. So whenever you're non-compliant with transfer pricing regulations, a straightforward penalty of 10,000 dirhams is applied by the FTA. Then obviously, if you are late towards the payment of that penalty that is applied, then a 14% annual interest is accrued and gets calculated on a monthly basis. So generically, these are the penalties that are applied when a company is in non-compliance with the transfer pricing regulations. But the main one is a company can lose its qualifying free zone person status if it does not have a transfer pricing study or a complete benchmarking study done. Next. Okay, next up is e-invoicing. So as you guys are aware, e-invoicing is a newer compliance requirement in UAE. And as we are all aware that the initial deadlines will fall from October, which we'll see in the next slides as well. So at start, we see how generically how the e-invoicing will work in UAE. So as of now, if a business is doing business-to-business transactions or business-to-business invoicing, they just raise a PDF invoice or an invoice from their software and it's directly sent to the customer. FTA at this point in time is not involved when we are sending invoices to our customers, which are primarily business-to-business transactions or business-to-government transactions. Just for the purpose of understanding, business to consumer transactions are out of scope under this implementation framework of e-invoicing. So if any business has a business to consumer transaction at this stage, they are out of scope under this implementation framework. They will be doing e-invoicing, but there will be separate deadlines for it. But currently, the purpose is to cater business to business transactions under e-invoicing. Excuse me. So whenever an invoice is issued to from one business to another, there is a 5-corner model, which is called the PEPOL model, required by the FTA. Each of these steps in the 5-corner model must be completed in order for a transaction to be successfully submitted with the FTA and your invoice to be approved. If any of this step is missing, either from your ASP or the buyer's ASP, or if the FTA's network is down, then the invoice will not be issued. You will have to reissue that invoice. So how will it work? So what a seller will do is they will raise an invoice and we'll at this point in time, we are assuming that they have integrated their ASPs with the ERPs that they are having right now. So they will go into their ERP system, they will raise an invoice. So what the ASP will do is it will take the invoice that was raised from the system and it will remit the details which will contain the 52 mandatory fields required by the FTA to the PEPOL network. The PEPOL network is FTA's network that will ensure that all the required fields that are required under UAE VAT laws and e-invoicing laws are there. Once it approves, then the invoice will be sent to the buyer's ASP, which will fetch data from the PEPOL network or from the FTA's database, and then it will send the invoice to the buyer. So it's a step-on-step procedure. So every invoice will be sent electronically. First, it will be sent through an ASP, which will be an intermediary between the company and the FTA itself. So once the invoices are remitted to ASPs, ASPs will send data to the FTA's network. FTA will validate the invoices. Then those invoices will be sent to the customer or the buyer that you have, and to that buyer's ASP will fetch the details and send the invoices to the end buyer, and they will receive the invoices. So this is a 5-corner model that is required under UAE e-invoicing law. And under the law, you will have 14 days. So there can be instances which we are being informed that there can be instances that the FTA network is down or the seller's network is down or the ASPs are down. So a client has or a company has 14 working days to ensure that the tax invoice is raised. So what will happen if there is an error when you are raising a tax invoice? So there is no way to amend an invoice once it has been raised. So we must be very careful when raising an invoice. Once an invoice is raised, the only way to amend the amount or the customer or any error is to issue a credit note. There you cannot edit the invoice in any ways once the invoice has been issued. So we need to be very careful when issuing initial invoices and sending it to ASPs and then submitting to the PEPOL network, so that any invoice, once it's submitted, there is no way to edit it. You must post a credit note against that invoice. Obviously, it's a phased implementation. So the first phase is the pilot phase, and it is applicable on companies that has revenue over 50 million dirhams. So any company which have a turnover of more than 50 million dirhams should appoint an ASP by 30th of October and must go live with this PEP 5 corner PEPOL model by 1st of January 2027. Failure to do so will again result in penalties, which we will be discussing later onwards. Once the go live is done for large businesses, then any business that has a revenue below 50 million dirham, which will cover mostly every company in UAE, they must appoint an ASP, and the mandatory go live deadline date for them is 1st of July, which we will believe will be extended by 1st of October 2027. But there were some confusions regarding that if a company is not registered for VAT, it is not required to do invoicing. That understanding is not correct. Even if a company is not registered for VAT, e-invoicing is mandatory for every business that has transactions with other businesses. So if a business has a B2B transactions or B2G transactions, regardless of the fact they are registered in VAT or not, they are obligated by e-invoicing regulations to be registered for invoicing, appoint an ASP, and issue invoices. So yeah, these are the deadlines. Now we'll move over to the next slide. So the penalties for non-compliance is, for example, if you are you failure to appoint an ASP, and you will get a straightforward penalty of 5,000 dirhams per month till you appoint an ASP. So for this purpose, I believe an understanding is very important that every company which has transactions with businesses, that is issuing invoices from one business to another, must appoint an ASP. So obviously we have their deadlines, but failure to do so will result in a penalty of 5,000 dirhams per month, and it will keep on compounding until an ASP is appointed. So as I told you earlier, there is a 14 working day time period allowed by the FTA for you to issue an invoice through ASPs, and invoice must be submitted into the PEPOL network. Failure to do so will result in late invoice issuance penalty of 100 dirhams per invoice. Now, and if, for example, as I've already informed you, there can be cases when you have issued an invoice, but the FTS network was down, or there was an issue with the ASPs, or the 5 corner model was not completed. So, and you are unable to report that system failure to the FTA, there is again a 1,000 dirham per day fine on that as well. So whenever you are issuing an invoice, kindly ensure that the 5 corner model is completed and every box is ticked, and your customer receives the invoice. And if there is any error, kindly make sure that it is done within the 14 days grace period to issue that invoice. So again, as you guys are aware, FTA is very strict on penalties. Okay, well, I believe that's all from my end. Matt, over to you now.
Oh, I believe Matt is experiencing some technical difficulties. Let's see if he's able to.
Can you hear me now? My
Yes.
apologies.
Yeah, we can.
Perfect. Sorry about that. I was trying to get my stuff working. Yeah, thanks guys, that's super helpful. I'm sure.
Oh, actually, Matt, sorry, 1 second. Your mic has gone funny again. Maybe try and reconnect. In the meantime, I can take over in your place, so don't worry about that. So we're obviously discussing a little bit before. Matt works part of the business development team, and over the last couple of years since the corporate tax and now the e-invoicing deadlines have come into place, or e-invoicing regulations, sorry, there's lots of questions that keep repeating from clients. And I think Samir and Amir have experienced the same. So we've consolidated a short list of questions that we've had on repeat that the guys are going to then address. So we'll go through them one by one. But then subsequently, if you guys do have any further questions, like I said at the start, please put them in the chat section or the Q&A section, and we can get to them right after these. So some of the questions that we get asked on a regular basis. Number one, guys, if I'm based in a free zone, do I qualify for qualifying free zone person relief?
Yeah, so technically being in a free zone does not mean that the company can qualify for a free zone, for a qualifying free zone person basically, and then can claim 0% benefit. So as we have gone through all the slides previously covering this topic, so technically the company will have to assess its eligibility on an annual basis. That includes assessing whether the company meets the substance requirements in the UAE. The company is carrying out qualifying activities as per the activities listed in the city law. And then the companies also have to ensure that they are meeting all the transfer pricing regulation requirements as well as audit requirements. So once all these requirements are satisfied on an yearly basis, then the company can continue to claim 0% tax benefit and can be called as a qualifying free zone person in the law.
Can I include all my entertainment expenses while filing the corporate tax return?
Yeah, so there is a bit of discretion between the type of the entertainment expenses. So for example, the expenses, the entertainment expenses related to employees, staff, all those expenses are fully deductible from the revenues. However, the expenses related to the client's entertainment, gifts and all, those are only allowed up to 50%, which means that when calculating the taxable income of the companies, 50% of those client-related expenses will be disallowed. So yeah.
Okay. Little scenario for you. This is an example of one, but we've had similar. My total sales are about 700,000 dirhams, but I have received a property disposable gain of 3.5 million dirhams. Can I claim small business relief as my sales are only 700,000, sorry?
No, in that case, basically, we do not have to just consider the sales as per the business activity. For the small business relief, as per law, we have to consider the gross sales of the company. And when I say gross sales, that includes the income from the revenue from the main core activity of the company, plus any other income that can be, a capital gain, right? So we have to consider the total income. And if that is below 3 million dirhams, then the company is eligible to claim small business relief.
Okay. And as it relates to substance, what should we do to have substance in the UAE? Do things like golden visas contribute towards substance?
Well, I would say golden visa only would not suffice this substance requirement. So a company has to have a proper office, working employees, core income generating activity should happen within within the free zone. And, all these conditions has to be satisfied to prove that basically the company is fully operational within the free zone, have valid assets, adequate assets, employees, working environment, decision making has been taking place within the free zone. So these all conditions basically would suffice the substance requirements in a nutshell.
Okay. I have a related party transaction, but my transfer pricing study has been done in another jurisdiction. Will this be accepted in the UAE, or do I need to conduct a separate one here?
Yeah, if the benchmarking study has been done in accordance with the UAE transfer pricing laws, so it will be acceptable. But if it is not, then a separate transfer pricing study must be done inside UAE based on UAE transfer pricing guidelines.
Okay. So it depends on the jurisdiction and the
Yeah.
relationship. Yeah, the relationship. Okay, the second part of the regular questions that we get, can sovereign assist with transfer pricing studies?
Yes, we can assist with transfer pricing study and benchmarking analysis. We do have a partner firm and that covers all aspects of the UAE transfer pricing laws.
Is e-invoicing applicable to businesses that issue invoices directly to consumers?
Yeah, e-invoicing is not applicable to businesses that are issuing invoicing to consumers, as I've explained earlier. This phase of implementation for e-invoicing is only for business to business transactions or business to government transactions. For business to consumer transactions, there is a separate framework which will be implemented at a later stage. But for now, this stage is solely for business to business transactions.
Okay. And you mentioned before with e-invoicing coming in that companies have to assign an ASP, and we have had questions before about whether we can act as an ASP for e-invoicing.
Yeah, so we are not an approved ASP, but we do have our partner firms that are ASPs and sovereign do assist with appointing ASPs if our clients do need assistance on that front.
Okay. How can I use e-invoicing when my customer is not registered for e-invoicing and he falls below the threshold of 50 million? But I am registered for e-invoicing as I'm above the threshold.
Yeah, so it's a very interesting question that one of our clients raised, and we felt the need to incorporate over here. So there will be cases in the upcoming months because it's a phased implementation that some companies will fall under the first phase of implementation and they are obligated to issue e-invoicing. But it can be a case that they are issuing invoices to customers which fall below the 50 million dirham threshold and they are not obligated to do the invoicing. So what a company should be doing in that aspect? So if a company is registered for invoicing, if its annual revenue is more than 50 million dirhams, it should issue an invoice. So when their ASP at this stage will have a specific option that they will need to select that their customer that they're invoicing is not an registered e-invoicing business. So even though the invoice details will go to the FTA, but no invoice will be sent out to the customer because they have not appointed an ASP yet. But how you will send the invoice to the customer will be the same that way that you have been sending before. You will send a PDF invoice